Well, hello and welcome to Moneycontrol special segment, which is Earning Express. I'm your host, Nickey Mirchandani, and we're here to talk about another company, IT company. After mixed set of numbers by TCS, all eyes will now be on Infosys. Notably, the share price has jumped 5% in the last 7 days, beating Sensex in the run-up to its second quarter earnings. Infosys is expected to see a marginal revenue decline due to weak discretionary spends and slower deal ramp-ups. The company's PAT, profit after tax, is projected to grow due to easing margin pressures due to weaker rupee, according to most of the analyst community. However, the street expects Infosys to report better revenue growth in perhaps the second part of the financial year due to the larger deals announced during the quarter. Do bear in mind the fact that the company in the last quarter remained cautiously optimistic in the commentary but made a steep guidance cut. To talk more about the earnings, we've been joined by Apurva Prasad, Vice President, Heads Institutional Research at HDFC Securities. Morning there.
Good morning, Nickey. Thanks for having me.
Pleasure is all ours. I'm going to start off by asking you your initial assessment from Infosys earnings, the expectation that you have from Infosys after the mixed set of numbers that TCS has reported. Do you think the company will somewhat stick on to the guidance range that, the guidance it has provided in the previous quarter, but somehow narrow that range? What's your expectation?
So we do expect Infosys to hold on to the guidance. 1 to 3.5% will be held on. And for the quarter, we do expect about 0.9% sequential growth in dollar revenue and a slight improvement in margins, more or less flattish margins for the company. But I think where it's going to stand out is on the deal booking side. And some of the mega deals they had announced a few months back, I think all those will show up in much stronger TCV bookings, which is what is going to give a much stronger exit to Infosys. So from a run rate basis, Q4 FY24 should be much stronger, as is the case for some of the other peers such as TCS or HCL Tech.
All right, if I was just supposed to ask to put down three key monitorables that one can watch out for from Infosys earnings, what would that be?
So I think some of the forward-looking indicators. So the net new within the large deal bookings, which is what they report. So I think that number becomes important. I think the commentary on North America and BFSI and the communication vertical. This is where most of the stress continues, in the system with pressure and discretionary spend. And thirdly, outlook on hiring and some of the supply side metrics, because the net addition has been coming off, it's been rather declining, and which is in some sense a near-term demand indicator. So I think these would be probably the more important things to look out for.
All right. Also, something in the like of margin performance. You spoke about hiring. Clearly, that was the trend which was disappointing for TCS clearly. In terms of the margin profile, however, for TCS was a little bit better. How are you looking at it? What are the margin levers for Infosys in this quarter?
So broadly for the sector, I think what has happened is that with attrition coming down, I think that's a big positive, because the cost of replacement actually becomes much lower. But that's not an incremental impact, as was the case about a year back or so. So I think with attrition coming down across the board, that's going to be supportive. And even if you look at TCS's commentary after big drop in attrition on an LTM basis, they've indicated the next quarter it comes down even further. So I think that's going to be a similar trend that will play out in case of Infosys. The point of difference, however, is going to be that the wage hike cycles are different. So while TCS is through that, Infosys is going to get into that. That's slightly different. But I think some of the traditional levers, such as optimization of third-party subcontracting costs, which did benefit TCS meaningfully. So of the 110 basis points improvement in sequential margin, almost half of that came from optimization of third-party subcontracting, which is also giving some sense of the near-term demand trajectory.
All right, in terms of the dollar revenue growth, perhaps a bit of disappointment came in from TCS, which reported a 3-year low dollar revenue growth. But what is the stance that you see for Infosys? Do you see a muted growth or a similar quarter growth for Infosys around that similar 1% level?
Yeah, so I mean, it has been a contrast if you see the way dollar revenue growth has been playing out as well as how bookings have been shaping up. So I think it will play similarly for some of the other companies too, Infosys included, where the bookings growth or TCV growth would be much more significant than the sort of softish Q-on-Q revenue growth. So like I was saying earlier, about 0.9% dollar terms Q-on-Q is what we expect, which should be better than where TCS reported. So TCS on a constant currency basis is flat sequentially. Yeah, Infosys could be better than that.
All right, that's the word coming in. Apparently, also, I'd want to chat about the buyback, if at all. How do you read through the buyback that has come through? Was the TCS buyback perhaps less than what the street was looking at or the analyst community was penciling in? One is that, and also the bearing of that perhaps with HCL Technologies, which will also be reporting in the numbers today. A, your expectation from HCL in terms of numbers, and B, also the buyback situation. Do you expect any kind of buyback coming in from HCL Tech too?
I mean, look, on HCL Tech, I'll take that one first. So HCL Tech should also record decent Q-on-Q, higher than Infosys. But what's going to happen is there is some inorganic, about 40-50 basis points sequentially, that should help from the consolidation of ASAP. So that is where it should be tracking for HCL Tech. The guidance for HCL Tech is much higher as compared to what some of the peers have guided. So we do expect that 6 to 8% that can be held. We are penciling in at the lower end of the band, but that is still well above, at least 200 basis points above what TCS has done, and at least 300 basis points better than Infosys. So that's where we are expecting HCL Tech. On the buyback of TCS, it is on expected lines. It is part of their capital allocation policy. They do pay out 100% free cash. It's been the fifth sort of successive buyback, and the quantum is not that large. I mean, it does translate to about 1% of equity which they do buy back. But yeah, it's largely within expected lines. But what it does is it probably creates a near-term sort of cushion for the stock.
Sure. Also, apart from the EBIT margins and the guidance, if one was just supposed to navigate back to Infosys in that case, we've already spoken about HCL Tech, TCS. Coming back to the focused discussion that we have for Infosys, apart from the margin levers, the commentary on the ramp-up profitability, do you think consumer discretionary spending, which still remains a pocket of concerns, would you be eyeing for more of the attrition problems and the reasons for senior leadership exit for Infosys?
Yeah, absolutely. So they have lost 2 senior leaders, and there is some trickle down that does happen. So yeah, I mean that will probably be more company specific factor. But at the same time, what's also happened is with the senior level changes, with a lot of competition, I think the price intensity has probably gone up on some of those larger deals. So yeah, it'll be good to also understand some of those factors. But having said that, look, they do have, it's a very institutionalized structure. The leadership pool is large. A lot of their leaders have gone on to head, even in the past, many of the competition. So yeah, I mean, beyond the point, it does become business as usual.
All right, Apurva, we'll leave it at that, and thank you so much for taking out the time and speaking to us.
Thank you. Bye-bye.
All right, next in line we have Mayuresh Joshi, who heads the equity research for William O'Neill Company, speaking about Infosys expectation, at least from the market standpoint of view. Mayuresh, morning there.
Morning, Nickey. Pleasure to be on your show.
Pleasure is always, as I always say. But, Mayuresh, what are you picking up? What was your read-through from TCS earnings now? Does that taper down the expectation or set the tone of weakness for the other IT majors too? I remember last quarter, Infosys delivered quite a shocker. You think any kind of disappointment, further disappointment, is in the offing for the IT players?
So, Nickey, to a large extent, TCS numbers were a mixed bag. The expectation in terms of revenue growth obviously disappointed the street. But two, three positives which obviously came out. Attrition rate and numbers have definitely trickled down quite significantly and expected to go down further. So that's a big positive. The second element in terms of expecting to maintain this order book wins between 9 and $10 billion. I think that's a huge positive in a scenario where a gloomy picture probably got painted, where orders might be far lesser over the next few quarters and pricing might be an issue. The management has not hinted on both these aspects. Order book expected to be between 9 and 10 and pricing expected to be remaining stable. With the wage hikes that have probably taken place, EBIT margins that they posted were far better than the street expected. And therefore, out of the base that TCS operates out of, I think it should be a decent set of numbers, in my opinion. Obviously, Q3, Q4, as we head into the next 2 quarters, are expected to be the weakest quarters because of furloughs, Christmas holidays in Q3, and clients firming up their budgets as far as discretionary spending is concerned in Q4. So I think these things will be watched out in the second half, which relatively means revenue growth would be on the softer side for the sector as a whole. Albeit a few players within the mid-cap IT spaces, which can be outliers and continue to do well. But a large element is that second half, which is expected to be on the slower side, will probably mean a bottoming out process for the IT stocks because a large element in terms of IT spends over the next few years will be accelerated across industries, including BFSI and manufacturing, which should support numbers as we head into 2025. So sentimental reactions being seen on TCS specifically as you see.
All right. If you're supposed to narrow down this conversation to 2 monitorables or 3 monitorables, Mayuresh, that you'd be looking from Infosys commentary and earnings put together, what would those be?
So one obviously will be on the environment itself, so pricing and what happens in terms of the core sectors, how are customer reactions specifically in BFSI, retail and manufacturing. That is going to be extremely pertinent. On a sequential basis, numbers for Infosys should be relatively better. So last quarter's numbers were a howler as far as Infosys is concerned. But this quarter should be relatively stable, both in terms of constant currency growth at 0.9 to 1%, which is the broad expectations. EBIT margins around 21%, expecting to maintain that margin band going forward. The second element is obviously also going to be expectations in terms of different geographies as well. And how client reactions are probably happening in terms of demand factors. So is there some element of softness that we are seeing for Infosys in particular, or is it for the sector as a whole? I think that is going to be very, very interesting as we head into what kind of order book dynamics, stroke geographic dynamics will IT companies probably deliver. And the third element obviously is going to be any tweaks that probably happen in terms of softness for a few sectors, which then might pull down a lot of valuation perspectives specifically for the sector as a whole. I think these 3 important aspects is something that we watched out for the universe as well.
All right, Mayuresh, we'll leave it at that. And thank you for taking out your time and speaking to us.
Thank you so much.
There was a time when, we had this entire dynamic change shifting out for a few years ago. Let's just say TCS was almost twice the size of Infosys, but the gap has narrowed down. So clearly Infosys, all eyes now would be on Infosys. There are a couple of things that you need to watch out. Profitability dynamics, commentary on ramp up of timelines of mega deals, margin levers, discretionary spending environments, reason for senior leadership, and effective date for wage revision. These are some of the key monitorables that we have for you. But with this, it's a wrap, and goodbye from the entire team who puts this piece together for you. Thank you so much for watching. Please do tune in for more.